Hello, everyone, and welcome. Thank you for joining us today. We're going to give everyone a minute or two to jump on this call from the waiting room, and then we'll get started. Thank you again for joining us this afternoon. Hello and welcome. If you've just joined, thank you for joining us. We're going to give it about 30 more seconds for participants to join, and then we'll go ahead and get started with today's session on loan readiness with the Acceleration Project. All right, I know I said 30 seconds, but we've got a lot to cover today, so we're going to go ahead and get started, and hopefully more people will jump on today's webinar. For those
Can
of
I
you
just
who
quickly ask whether the chat is available for everyone? Right now, I'm only seeing the ability to chat the host and panelists.
Naomi, if you put it in for hosts and panelists, our team on the back end will put it to everyone.
Got it. Got it. Thank you.
Not a problem. All right. Well, good afternoon and welcome, everyone. Thank you for joining us today for our Small Business Strong webinar on loan readiness with the Acceleration Project. My name is Amber Haskell, and I'm the Executive Director and Vice President for the Greater Boston Chamber of Commerce Foundation, and I have the pleasure of overseeing our Small Business Strong initiative. At the Greater Boston Chamber of Commerce Foundation, we are dedicated to supporting small businesses across the Commonwealth through multiple initiatives, including our Small Business Strong webinar series. First and foremost, we would like to thank the State Street Foundation for their continued support of Small Business Strong, as well as their dedication to helping small businesses grow and thrive across the Commonwealth. And of course, I would also like to thank the Acceleration Project for partnering with us for today's session. Before I introduce the Acceleration Project team, I have a couple of quick housekeeping items. First is this webinar is being recorded and will be shared on the Chamber's YouTube page shortly after the session. For those of you who are joining us live, please submit your questions throughout the webinar using the Q&A feature on the right-hand side of your screen, making sure to send to all panelists. We will also have some links that will be dropped in the chat for you all as we have the presentation. I will be on at the end of the presentation to put as many of the questions as possible to the team. And with that, I will pass it over to Naomi to share more about the Acceleration Project in today's session.
Thank you, Amber. It's great to have all of you joining us today. As Amber said, my name is Naomi Azrak. I'm a Senior Director at TAP, and we're so happy to be working with Amber and Kaja and their team in support of this Chamber's Small Business Strong program. At TAP, we're fortunate to collaborate with chambers of commerce and lenders across the country. And so we're happy to now include the Greater Boston Chamber as a new partner in that network. So since TAP may be new to many of you, let me just do a quick introduction. We're a nonprofit dedicated to helping small businesses grow and thrive by providing high impact consulting services across all small business functional areas. We've been around for more than 13 years, and we serve thousands of businesses every year through our network of about 200 consultants nationwide. And now I'm thrilled to introduce you to two of those TAP consultants who will be presenting today. Kelly built her career at Morgan Stanley in fixed income trading, working on both the money markets and the short-term corporate bond desks. In those roles, she worked very closely with loan type products and developed deep expertise in interest rate dynamics and cash flow management. So she's especially well suited for today's topic. And then Samantha brings over 25 years of experience in corporate finance. As Senior Vice President at iStar, she led major lending and investment transactions across a wide range of industries. With her expertise in credit analysis, structuring, and underwriting, she's also in a great position to talk about today's topic. Let me just quickly on a housekeeping note, please feel free to ask questions anytime, as Amber mentioned. Actually, the Q&A is the way that we're going to go, not the chat, right? So let's use the Q&A. for the questions, and we'll try to cover those as we go. But if we don't have a chance to answer your question, you can certainly sign up for a one-on-one coaching session, as Amber mentioned, and we'll share how to sign up for those at the end of today's webinar. So with that, I will turn it over to Kelly.
Great. Thanks, Naomi. Welcome, everyone. So before we get started today, let's take a little poll to get an idea of how you all feel about this topic. So what is the first word that comes to mind when you think about business loans?
And the way you can participate is either by scanning that QR code, or I'll drop into the Q&A. Let me see. Let me drop it into the chat, the actual link, if you'd like to use a link, and then maybe Kaja can share that with everybody.
So daunting, overwhelming, right? There's no right answer. Just want to get a feel for where you all are on the topic before we get started. Overwhelming. The larger the answer, the larger the word on the screen is, the more people are using the same word.
In the poll, you don't have to put your name in if you don't want to. You can skip through that. We'll have 3 more polls like this.
Mhm. Yep, scared, definitely complicated. Well, hopefully after today, it won't feel as daunting. Right, definitely. This topic can definitely be unnerving, but as a business owner, it's really important for you to have a general understanding, because at some point in your company's journey, it's likely that you'll need to access funding, and you want to be able to make the most informed decision as possible. So why don't we get started? Okay, so today's topics. Today's presentation will cover a number of topics, all with the goal of getting you comfortable with the different choices you have when it comes to sources of funding or sources of capital. We'll be focusing on loans or debt capital. So debt capital is the funds a company raises through various forms of borrowing. We'll talk about the different types of debt, what the different terms mean, and we'll explain the different structures. So loan structure refers to the loan term, the interest rate, the risk, any collateral you may need to put up, and repayment terms. We'll also touch on how to compare loans and caution you when it comes to higher cost options. Okay, so traditionally, there have been 3 ways for earlier stage businesses to fund their business. Bootstrapping is when you fund your own business without outside support through your personal savings or operating revenue from your business. You could borrow from friends and family. Loans or contributions from your friends and family is a convenient and quick way to meet immediate needs for cash. It is important, though, to be clear about the terms. Is this a loan? Is it an investment? Or is it a gift? Or you could do crowdfunding, which is raising small amounts of funds from a large number of people through online sites. These funds can be arranged as donations, profit sharing, equity, or debt. It's important to realize the platform you use usually charges a fee to the fundraiser. Okay, for more established businesses, they usually have more options when it comes to raising capital. They could look at grants, which are funds from government agencies, nonprofits, or corporations to stimulate growth. The money you receive from the grant does not need to be repaid. Also, you should never have to pay for a grant, so beware of any grants where there is an application fee. This is usually a scam. So who offers grants? Government entities, nonprofits, private companies, or corporations. A more established business could use the debt capital market to get funding. So debt capital is when a lender gives you money, which you repay with interest. So who offers these? Traditional banks, government-sponsored programs like CDFIs, SBAs, community banks, credit unions, online merchants. Or a more established business could access equity capital to get funding. So equity capital is when investors give you money in exchange for part ownership of your company. With equity capital, there is no loan to repay. They have a stake in your business. So who offers this? Private individuals, angel investors, venture capitalists. So just to give you an idea, an angel investor is an individual who is putting his personal money into your startup. He or she invests in the early stages of your business. The amount is usually smaller, usually under $1 million, and the role is passive. Whereas a venture capitalist is a professional investor who manages a fund. They invest in later stages of your business with larger sums of money, and they're usually actively involved in the business. Okay, so for today's presentation, we're going to focus exclusively on debt capital. Just a reminder, debt capital refers to funds that a business raises by borrowing, which must be repaid over time with interest. It is a form of financing where a company takes on debt. There are several key features. You are obligated to repay the loan, usually with interest. There are fixed payments. So as a business owner, you make regular interest payments and principal repayments based on your terms. There is no ownership dilution. The lenders do not take equity. So like anything, there are advantages and disadvantages. The advantages of debt capital is you maintain ownership and control of your company. Your interest payments are often tax deductible, and it provides predictable financing for expansion. The disadvantages are you have repayment obligations, even in tough times. Riskier businesses will have higher interest costs, and having debt on your books will impact your cash flow and financial flexibility. So let's talk about some typical products used by small businesses. So what are the typical debt products small business owners usually use? There are a couple of choices. The first would be credit cards, which are convenient and easy to access. They're useful for small purchases and can earn rewards, cash back, and travel points. They help build your business credit history. They have flexible repayment plans where minimum payments are allowed, but you do incur high interest costs of potentially 15 to 25%. You really want to pay your bill every month. You really want to work on making sure your credit history and your credit score is as high as it can possibly be. Another option is a line of credit. A line of credit allows for short-term borrowing, under a year usually. You can borrow up to a pre-approved limit as needed rather than receiving a lump sum all at once. The borrower can withdraw funds, repay them, and borrow again within the set limit. So this is known as revolving credit. So interest is only charged on the money you actually borrow, not the entire credit limit. So using a line of credit can be helpful when managing your cash flow when it comes to unexpected expenses. And then we have a term loan, which allows the borrower to borrow larger amounts of money. A term loan has a fixed, predictable payment schedule over a set period of time or term, which is usually between 18 months and 10 years. Accessing a term loan helps a business build their long-term business credit. Okay. So what is a small business term loan? A term loan is a sum of money that a borrower receives in a lump sum from a lender. The borrower pays back the sum over a fixed period with regular payments. Term loans offer predictable fixed payments over a set period, making it easier for businesses to manage cash flow and budget effectively. They can help improve your credit score if paid on time. They typically come with lower interest rates than other financing options, making them ideal for funding large, long-term investments like equipment, real estate, or business expansion. Okay, time for another poll. So which of the following is not one of the 5 C's of credit? Character, capacity, capital, creativity, conditions, or collateral? Well, seems like everybody got it right. You are right, creativity. The answer is creativity. While being a bit small business owner does involve, you do need to have some creativity. It is not one of the 5 C's of credits. So why don't we do a little review of the 5 C's of credit? Why are the 5 C's of credit important? When a business hits the growing stage and looks to get outside funding, lenders rely on the 5 C's of credit to assess risk. They really want to know, can the borrower repay their loan? They use the 5 C's of credit to set loan terms and decide on approval. So a strong standing in all 5 areas improves a borrower's chances of securing financing with favorable terms. So let's touch a little bit on each of these characteristics. So the first is character. And character refers to the business owner's credit history, their reputation, and their financial responsibility to assess their trustworthiness in repaying the loan. A lender will check your personal credit or your FICO score. They want to know, can you repay this loan? The next is capacity, and this refers to the business owner's ability to generate positive cash flow to cover loan payments, typically assessed through your income and/or your cash flow statements and your debt service coverage ratio. So this ratio measures whether a company has enough income to pay its debts. So the formula is net income over debt service. A debt service coverage ratio above 1.25 is considered strong. A lower debt burden increases your chances for approval. Then the next is capital, and this refers to the owner's financial investment in the business. It demonstrates, your commitment and financial responsibility and reduces the lender's risk. Then we have conditions, and this refers to external factors like industry trends, economic conditions, and the loan's purpose, which impact the borrower's ability to repay the loan. And then finally, we have collateral, which refers to assets like equipment, property, or inventory that the borrower pledges to secure the loan. So if the borrower defaults, the lender can seize the collateral to recover their losses. So secured loans or loans that use the borrower's collateral as backing typically have lower interest rates than unsecured loans. Okay, so let's look at an example of the different types of debt and why a retailer would use each type. So what would a retailer use a term loan for? A term loan could be used to finance the costs associated with opening a new store, such as leasing space, renovating, or purchasing fixtures. They could use a term loan for purchasing or upgrading equipment, such as point of sale systems or inventory management tools. A term loan can cover these expenses, allowing the business to spread the cost over time, or for large inventory purchases, especially when suppliers offer discounts for bulk buying, a term loan can provide the necessary capital without straining cash reserves. Okay, let's look at a line of credit now. A retailer would use a line of credit for managing seasonal cash flow. Retailers often face seasonal fluctuations in sales. A line of credit can help manage cash flow during slower periods by covering operational expenses. A line of credit could be used to cover unexpected expenses such as urgent repairs or sudden increases in demand. With a line of credit, a retailer would have quick access to funds. And then let's look at credit cards. A retailer could use a credit card for small recurring purchases like office supplies or minor inventory restocks. It can help with building your business credit. Regular use and timely repayment of credit card balances can help build the business's credit profile, potentially leading to better financing terms in the future. And most business credit cards offer rewards and cash back on purchases, which can be, an added benefit for routine expenses. Okay. Now let's look at the same debt examples and the different scenarios for a service industry. So a term loan could, finance the cost of leasing and furnishing new office space, allowing the business to spread these expenses over time. A term loan could be used to invest in new technology. Some service businesses, like consulting businesses, often require high-end computers or software or other tech tools. A term loan can help purchase this equipment without depleting cash reserves. It can also help with marketing campaigns, for large-scale marketing initiatives or rebranding efforts. A term loan can provide the necessary upfront capital. Now let's look at a line of credit. Lines of credit are particularly valuable for service-based businesses due to their flexibility. They can help with managing cash flow. Service business income can be irregular with gaps between project payments. So a line of credit can help bridge the gap during these periods. It can help with hiring subcontractors, taking on larger projects often requires hiring additional help. A line of credit can fund the hiring of these subcontractors and bridge the gap until the client actually pays the bill. And lines of credit can also help with professional development. Service businesses may use a line of credit to pay for training, certifications, or industry conferences. And then lastly, let's look at credit cards. For consultants who travel to client sites, credit cards can cover airfare, hotels, and meals, often earning rewards points. A credit card can be used to buy software subscriptions. Many consulting tools are subscription-based. Credit cards are ideal for these recurring smaller expenses. They're also ideal for client entertainment. When meeting with clients or prospective clients, credit cards can be used for meals or entertainment expenses. Okay, so now let's look at loan terms. We're going to talk about loan terminology. It's important for you to understand what each term means when it comes to evaluating your borrowing options. So the first is loan principal. And this is simply the original amount borrowed before any interest or fees are added. So if you take out a loan for $50,000, the loan principal is $50,000. Then we have loan balance. And this is just the amount that a borrower still owes on a loan at a given point in time. The loan balance decreases as the borrower makes payments over time. Then we have the interest rate. And the interest rate is the annual cost of borrowing expressed as a percentage of the loan amount. Factors that influence the interest rate include the borrower's credit score, the loan type, repayment terms, and market interest rates. And then we have the annual percentage rate, or the APR. And this goes a step further by not just including the interest rate, but also any additional fees or costs, such as loan origination fees or closing costs. So it gives a more accurate picture of the loan's true costs compared to just the interest rate. So it helps borrowers compare, different loan offers more effectively. So for example, if you take out a $50,000 loan for 5 years at an 8% interest rate, with fees, your APR, your annual percentage rate, is actually over 10%. So when looking at different debt products, you want to always use the APR for comparison, so it's apples to apples. The Federal Truth in Lending Act requires that every consumer loan agreement disclose the APR. And then finally, we have amortization, which is just the process of gradually paying off debt over time through regular payments that cover both principal and interest. Each payment reduces the loan balance, with a portion going towards interest, especially in the early years, and the rest going towards principal. So it's important for any business owner to understand these terms. So when the time comes to access funding, you can compare loan options and make an informed decision that best fits your needs. Okay. Okay, so here's just a visual of a $50,000 loan. This graph shows the monthly payments of $1,013. Look on the left index. The borrower pays the same $1,013 every month, and how the payments are broken down into principal and interest. So the loan balance, remember, starting at $50,000, see on the right index, the loan balance gradually decreases as you make payments. Look at that red line. In the early stages, a larger portion of your monthly payment goes towards interest. That's the light blue section. But over time, more goes towards reducing the principal, which is the dark blue section on the bar graph. By the end of the loan term, the balance reaches zero and the loan is fully repaid. So this illustration, doesn't show a full payment balance schedule. It really is just a visual representation of how a fixed loan payment amount is broken into interest and principal components. Okay, so what are the payments on a loan? So let's now look at an example of a 5-year term loan for $50,000 at 8% interest with some typical fees. So the loan principal, or the amount the borrower is receiving, is $50,000. The stated interest rate is 8%. There are fees of 5% for origination, which comes to $2,500. You take the loan principal, $50,000 times 0.05, plus a $750 documentation fee. So together, those add up to $3,250 of additional costs. The borrower has a fixed monthly payment of $1,013. So every month, the borrower pays the same amount, which makes budgeting predictable. Over 5 years, your interest costs are $10,829. So the total repayment comes to $60,829. The original $50,000 plus the $10,829 in interest costs. When you factor in the origination fee and the documentation fee, so remember the $2,500 plus $750, which equals $3,250, total interest plus fees is actually $14,079. So the true borrowing cost, or the APR, annual percentage rate, is 10.89%, which is higher than the stated 8% interest rate. So as you can see, the APR gives a much more accurate picture of the total cost of a loan compared to just the interest rate. So when comparing different options from different lenders, you want to always use the APR so it makes it apples to apples. Okay. And the next one. Okay, so now let's, something to think about when looking at accessing funding is what's known as maturity matching. So loan maturity matching is a financial strategy where the term of a loan is aligned or matched with the useful life of the asset being financed. So this ensures that the loan is repaid around the same time the asset is no longer useful or generating revenue. So for example, a business might use a 5-year loan to finance equipment expected to last 5 years, helping maintain cash flow. So, this helps maintain healthy cash flow and avoid any financial strain, which could happen if the loan and the asset life were not matched. So, maturity matching is definitely something to consider when looking at term loans. Whether it's the best approach for you depends on your specific financial situation, market conditions, and your goals as a borrower. So now I'm going to hand it over to Samantha.
Okay, so we're going to start with another audience participation slide. If you were to secure the perfect loan, what would you use it for? We're asking you to input your answers. Hiring, it's good. Marketing, materials, expansion, emergencies, property, purchase, expansion, all good. Inventory. Okay, so that those are all good answers. I will make a note just from a lender's perspective, that when you are, looking to borrow money, a lender is primarily looking for a real substantive breakdown of the uses. And the one thing I'll say is that in terms of the uses, it's good to have the bulk of the uses be sort of substantive, tangible uses in terms of equipment or hiring people. Marketing, which I sort of consider to be more of a soft cost, can be hard for a lender to sort of grasp. They like sort of uses that can be directly attached to expansion. Just a note for you, for the small business owners. On the next slide, on this slide, here's a list of typical requirements that a lender might have. This list probably is more like a traditional bank would ask for. Different lenders ask for different things, so you should just be open to what is requested. But just going down the list real quickly, you can read these yourself, yourselves, tax ID number or employer identification number. They might want to see your license and registration information, a personal credit report. As we'll mention down below, and as Kelly talked about briefly, most lenders will look for collateral, having a lien on your bank accounts or on any property that you might own, any equipment. Now, a lot of small business owners may not have a lot in the way of collateral, and most lenders, with or without collateral, will usually ask for a personal guarantee. And so because of that, they'll also be looking for a personal credit report. So you should have that ready. The lenders will want to know about your time in business, what your revenue looks like, and will look like. Also, they'll be interested to know how you funded your business to date. Um, as Kelly talked about earlier, if you can show how you've put in capital over time, how you've managed your business up to the point of borrowing. Those are all good things that a lender will want to hear about. Sorry, and just a few more notes on that previous page. Um, a business plan and financial documents. Financial documents are very important, obviously, both historical and projections. As a lender, they'll really be interested in seeing what your projections look like. You should think about putting together projections that show sort of the best case scenario, that show what your cash flows will look like, giving effect to the loan you're going to take out and the various uses of the loan proceeds. Um, Obviously, you have to be able to justify your projections, but again, showing your best case, a run rate analysis of what your cash flow might look like, giving effect to the loan. Business plan is always something that will be important. But along with that, just a few things to mention that you as a small business owner will have to be ready to sort of sell yourself. You are probably the most important part of your small business. So you have to be ready to sell yourself, to be able to talk about your competition and what differentiates you, what makes you better, why are your customers going to keep on coming back to you? Um, and then the final thing I'll just mention is it's always good as a small business owner in talking to a lender, but just for your own purposes in terms of your decision making, is to always ask yourself, what is the main question you're trying to answer? What is the need that you're trying to fulfill for your customers? Why does your business exist? It's always good to think about that for your own purposes, but also be ready to talk about it when you're talking with the lender. Okay, next slide. Kelly went through a breakdown of credit cards, line of credit, term loans, sort of your more traditional regulated sources of debt financing. I'm going to talk a little bit more in depth about merchant cash advance and MCA. Not only because you will likely come across offers for them, they can be very sort of enticing ways to finance your business. But you need to be careful. So I want to go through it in a little more detail. These are products that are typically offered by online service providers. So a Shopify, a PayPal, a Square. A lot of these entities will be offering what we'll call MCA, Merchant Cash Advance. They have a variety of names or titles. They might sales-based financing, online working capital. They're named different things, but we'll call them, for the purposes of this discussion, we'll call them MCAs. They can be enticing, as I said, because typically They won't do a credit check. They'll be real quick in being able to provide the funding, but they will require frequent repayment. They're not regulated, so you have to be very careful. You don't want to get into any conflicts because they're not regulated, and you may not be protected if something happens. And likely it'll end up being the highest cost of funding for all of the debt products that that we've been talking about. On the next slide, just a little more detail about the structure of an MCA. Typically, what happens is a business would receive a lump sum payment, and in exchange for that, there's going to be both a factor rate, which we'll talk about more in a minute, and a holdback. The holdback is the amount of daily or weekly sales that'll automatically be deducted from your credit card and or debit receipts that you're receiving. And it's usually a quick repayment, a full repayment of 18 months or less. So again, what will happen is the the MCA provider will be withholding a percentage of your sales as they come in. And as I mentioned before, the providers are typically payment processors or other e-commerce platform providers. Going on to the next page, we'll show a little bit more in detail about how it works. So let's say the amount that you've agreed to is a $50,000 cash advance. The MCA provider will add a factor rate. In this case, assume 1.5 times. So if you multiply the 50,000 by the factor rate, the total amount that you'll have to return to the MCA provider is $75,000, a cost of $25,000 on top of the original $50,000 that's been advanced. And let's say you've all agreed to a 20% daily sales holdback. So in the chart on the right, you'll see that let's say you collect $1,500 of sales a day. Again, these are just assumptions. The MCA provider is going to hold back $300 per day. And they will continue to hold back 20% until they've received the total payments of 75,000. If you're earning $1,500 a day on sales, that'll take 252 days to repay the total amount. Now, if you calculate the APR, which Kelly talked about in some detail, it ends up being 72%. That's the annual percentage rate. That's giant. So it's really important to be careful of an MCA. Just going to the next slide, this will show you sort of a comparison between a 5-year term loan that Kelly talked about versus the MCA, using the assumptions that we showed on the previous slide. Again, just showing the monthly payment amount for a term loan with an 8% interest rate and the fees that were discussed, you're paying $1,000 a month. With the MCA that we outlined, it's $6,000 a month. And as you see, the APR, as we talked about, that's always the best way to do an apples to apples comparison of two debt products. The differential in the cost is just quite substantial. Um, a loan, more predictable, as Kelly talked about, easier to manage. MCA, it's a high strain, frequent deductions. As we talked about, the provider withholds a percentage of sales. So overall, the loan is much lower risk and lower costs than an MCA. But as we talked about, the MCA can be pretty enticing because it's such a quick turnaround. Maybe you're not quite at the stage of being able to arrange for a low interest rate loan. But if you are going to look to do an MCA, it's important to consider all that we've talked about. Next slide. Again, the 20% holdback. It's like a 20% price reduction. Um, it's likely that the cost of your borrowing in an MCA is going to be far in excess of your profit margin. And this is the goal really of borrowing is that and by the way, companies large and small borrow money. And I know, back when Kelly did her audience survey of the words that come to mind, daunting, overwhelming, people think of debt as a bad thing. And it can be bad if you borrow too much. But as long as your profit margins are in excess of the APR on your debt, it can be a very attractive way to fund your business. So if your all-in APR is 10%, but you take that $50,000 and you're able to invest it in your company and earn, call it a 15% profit margin, then borrowing that money makes sense. Most MCAs will require personal guarantees, as we talked about. And again, there's very little regulation, so your protection is limited. Always something that you want to watch for. Before would enter an MCA transaction, very important to read the fine print, understand what you're getting yourself into. Because again, it can be enticing, but risky and probably very expensive. The next page, again, just highlights um, really all high risk, high cost loans that you should be careful of. Any lenders or providers that are willing to make quick decisions that have very sort of limited loan documents. Maybe they don't even ask for a credit report. They're willing to give instant approval. These are things to be careful of. Any providers that are looking to frequent or automatic repayments, another thing to be careful of. And then a factor rate instead of an APR is something to watch for. And again, these products might not have good protection or be regulated. On the next slide, here are some of your sort of more responsible lenders for small businesses. And Kelly talked a bit about this, but just to go through three of them in more detail, the traditional banks are probably your best bet when you're more established, when you have more of a track record, good credit, and strong financials. They will be typically more flexible in arranging the terms to fit your needs. They probably will be looking for guarantees and or collateral, and they may be more strict in some ways and have more full-blown documents that suit your business. But all of that is in return for a lower interest rate, probably, and best for established businesses. SBA-backed lenders, they sort of fall in the middle between traditional banks and what we'll talk about later, CDFIs. Best for sort of early stage and small businesses, but that are businesses ready for, that do meet certain criteria and would, allow for lower interest rates and longer repayment terms. So again, ideal for those companies that might not yet meet the criteria of traditional banks, but do have some track record and success in having at least built up their business and operated for some period of time. And then finally, there are CDFIs, Community Development Financial Institutions, which are really best for beginning stage businesses, those that might not have superior credit, may not have a long time in business, might not have the track record. Um, uh, but they can be attractive, loans. And it's often that the providers, the CDFI providers, offer more assistance and business support. So for those that are in the early stages, may not have the good track record yet, they can be good options. Next slide. So now we're going to do one more audience participation. Hopefully this will be easy for you guys since we kept on repeating it. But which is the following way to compare the different products, apples to apples, comparing different options. And yes, it looks like well, interest rate is good, yes, but APR is even better because it adds in all the fees. So really, it's best to look to the APR. Again, that takes into account all the various fees that you're paying. It's really the best way to compare different debt products. Okay, the next slide. And these are just some key takeaways. That the debt comes in different forms, different providers, different structures. You want to try to understand the different options and match them up to best meet your strategy and your goals. Again, selecting a type of loan based on the use of the proceeds. As Kelly talked about in some depth, if your main issue is operating shortfalls, seasonality, often a line of credit might be your best bet. If you're in a stage of expansion where you might be buying equipment, looking to rent a new property, making a big investment, a term loan might be your best bet. But lenders, should be prepared to talk with you about the different options. And it's always good to understand and compare the different loan terms. Make sure they suit your strategy and your business using the APR calculator to compare different options. Always good to try to avoid the high risk, high cost loans, which may include MCA transactions. And finally, it's always good to, have your lender requirements lined up, have them ready early. The other thing I'll say about a lot of the lender requirements, including, your financial statements and your projections and your business plan and maybe a pitch deck that you might have. It's always good to step back from time to time and look at those items, update them. They should be living documents and they should be available to you so you can make the best decisions for your business, not only if you're about to talk to lenders, but also just for your own purposes. It's always a good idea to have those things ready and updated. I know small business owners tend to be putting out fires a lot, dealing with the day to day. It's always good to step back and think about having these things ready and answering the big questions so you can run your business appropriately. And I think I will turn it back to Naomi.
Yeah, that's great. Thank you both, Kelly and Samantha, for such a clear and engaging presentation. I think both of your expertise really showed in the way you explained all the content in a way that was really easy to follow. So thank you both. Do we have questions? I mean, I know there weren't any in the Q&A, but we have a little time here, right, Amber, for a couple. If anyone wants to throw it into the Q&A or even raise your virtual hand and maybe we can even take it live. I also invite if there are lenders on the call, if you want to add any comments or additional insights on today's topics, please, we welcome you to do that as well.
Naomi, can I ask a few questions that we typically get from small businesses kind of on the regular? One is, you guys talked a lot about APR, which is incredibly helpful. What is the range a small business owner should be looking at of, hey, this is, I know you said to compare it to, what your expected kind of revenue will be, from that loan, but when you go from, hey, this is acceptable to potentially this might be predatory lending or those MCAs, what is hey, a loan in this kind of APR range is typical that you would see from a lender? What could you put like a brackets around what's like, hey, from here to here is a good option?
I mean, I think it probably depends. I'll let Samantha and Kelly chime in as well, but it will depend on the loaner, the lender, the product type, the maturity, the personal credit score of the borrower. But I think maybe is a range up to 20% is reasonable. I think over that you start to get a little concerned. Samantha, you want to add to that?
Yeah, I mean, I'll just to spend a minute on it. The way a lender typically will price a loan, at least in my experience, is they take the current interest rates in the market, call it, if it's a 5-year term loan, let's say, they'll look at the 5-year treasury rate, that's out there listed
Mhm.
in the market that's helped set by banks and by the Federal Reserve. And then they'll add on a risk factor. So a typical, I don't know what the 5-year treasury rate is right now. Call it, 5%. I don't know what it is at the moment. but then they'd add on sort of a risk factor, giving effect to, after underwriting the business, underwriting the environment. So 10%, 8%. If it's a shorter term loan, it might have a lower interest rate. For a longer term loan, because you're basing it on a longer term treasury, it might have a higher interest rate. But yeah, I think Naomi's right that you definitely don't want to be getting above 15 or 20%. That just does not calculate. And it's unlikely that the formula I was talking about, looking to have a profit margin that's in excess of your cost of borrowing, it's unlikely that arbitrage would be interesting for you. So for sure, I think you want to be looking in the 10% range, 15 maybe at the high end.
And we're talking about non-collateralized, obviously, loans. Like collateral will change things quite a bit. But
Yes.
yeah, right.
We have a great question in the chat. It says, if you're looking to purchase a property, does it make more sense to save money for the deposit or guarantee, or is it better to use that money to pay down business credit card debt? So that's saving versus paying back, a loan for, that you've used for the business previously.
Go ahead, Samantha. I'm sure you
Sure.
have thoughts in this.
Yeah, but the credit card balances, as Kelly talked about, they can get really high. So I think, you're always going to want to try to not carry balances month to month. Oh, you're going to want to try to pay it down by month. Um, but yeah, if you're going to borrow money to buy a property, now you might want to look to lease a property. These are all considerations that you'll have to make. But yeah, the top priority is probably always going to be to repay your credit card balances. It's always going to be, if instead you're holding money aside, you're probably not earning as much money on that money, as much on that as you're going to be repaying in fees to the credit card company.
And then if I could sneak one more question in here is, a lot of times, people will give the advice, get to know your local bank, right? Get to know your local banker. For a small business owner who is busy, why is that so important? Why is it so important to build relationships with a lender?
It is so important because, a lender borrower relationship is a relationship. And that whole character that Kelly talked about, that first C, is really playing into this, right? They need to understand and trust you, and that comes with time and getting to know you. So starting that relationship early, even if you don't have everything, ready to go, even if you don't qualify yet, it's still recommended. And we've worked and provided programming with banks who, we worked with Key Bank in the Midwest, and they said, get in touch with us sooner than later, even if you're not ready now. We'd love to hear from you. So, it's never too early.
And they can always be a good potential lender going forward into the future. They've seen how you operate. They may, you might have your bank accounts with them, so they see the kind of revenues that are coming in. They see that you're a trustworthy client. So they can often, know your business best and offer you the most sort of flexible, low cost loan when you're ready.
Also can be a great mentor too.
Yes. And have good connections.
Mhm. Wonderful. Well, thank you so much, Naomi, Samantha, and Kelly, for today's presentation. And thank you for everyone who joined us live. As I mentioned earlier, this has been recorded and the recording will be sent out to all participants afterwards. Um, we
I
would
wanted
love to
to
have,
just, sorry,
oh,
do you mind if we throw up the uh, survey link just because before we close out, we wanted to just have that ready for people
yep.
to fill out after the session.
Yep,
That would be great.
it has just been put into the chat for everyone.
Awesome. Perfect.
So thank you all so much. We hope you will fill out the survey as well as attend another webinar that we have coming up. On October 1st, we have Rethinking the Revenue Stack. This free webinar will introduce strategies for pricing, reoccurring revenue, and supplier ecosystem engagement. So great to build off what we talked about today. And then on October 22nd, we'll be having our Utilizing AI for Small Business, which is another timely topic where business owners will learn simple frameworks to pinpoint where AI can make a difference. If you are looking for support to learn more about different loan products, the Acceleration Project has been very generous and is offering one-on-one coaching for participants today. As you can see, you can sign up for that. That link has been put in the chat. And then lastly, the Federal Reserve banks are conducting a survey on small businesses and credit. The survey will give small business owners and key financial decision makers the opportunity to share your recent experiences about whether you use debt and what financial conditions you face. This information will be to help the Federal Reserve banks better understand the credit ecosystem for small businesses. So if you're willing to fill that survey out, it will really help not only the Fed, but also chambers of commerce across the country understand how we can better support small businesses. For more information and to sign up to hear about Small Business Strong and all the programming we offer, we advise you to go to gbccfoundation.org, sign up for our newsletter, reach out to us, and learn more. And with that, thank you to you all for joining. Thank you to the Acceleration Project for presenting today, and we hope to see you soon.
Thank you, everyone.